Well, the US dollar hasn't actually reached those record lows yet. It's still around about 5 to 6% off their lows. It's actually just marking time. With the US dollar, we just got to make sure, and we follow it via the US dollar index, on a break to new lows. But we are finding this just holding up.
Okay. Speaking of indexes, Baltic Dry is one that you are keenly across. Just tell me what that is doing for perhaps painting a longer-term projection on demand, particularly when it comes to China.
Yeah, the Baltic Dry Index, as we know, it's just it's freight rates around the world, and it's mainly used for primary inputs, you know, iron ore, coal, all these sorts of things. But what we have seen is a pick-up in the price for the rate, something we wouldn't really see around this area of time. Normally we see a pick-up sort of December, but at the moment it has started to pick, and that gives us a little bit of a sign perhaps that we're getting out of this economic downturn.
Well, you say perhaps. That's kind of almost hedging your bets, because what makes you confident that it's not stockpiling, that it is actually implying consumption on a broad, continual basis?
Yep. It's consumption that's also being used. We see imports.
Why is it though? Why is it being used as opposed to stockpile? What makes you say that?
Okay, because we're just heading into the Northern Hemisphere winter, so they're actually drawing down, and they get ready for the build for summer. And I think that's the interesting thing, because the consumption is there, and we can see that via inputs of base metals, particularly copper and zinc, coming into China, for instance. And as we see it come in, they're using it, stockpiling, and getting ready for the summer build.
Because, okay, using it and stockpiling. Do you know the breakdown, Jonathan? Because that's important. They're a third of the world's demand for those suite of commodities, China. So it's important we know which component is being used now versus stockpiled.
You won't really know, but what you've got to make sure is you can't stop that engine. You can't stop that engine. You can't stop that stimulus package.
When you say you can't stop it, China can turn the tap off tomorrow and it will stop.
Yeah, but in terms, if you're halfway through a highway or something like that, or a bridge, you can't stop it. So they must have that continual flow of these goods.
All right.
If they don't, then they have got to consume.
Have you been to China, Jonathan, outside Shanghai and Beijing?
Yeah.
You have?
Yeah.
Okay. Do you really get a sense that the mentality is there to suddenly start spending when there is no safety net in China?
I mean, I know there's no safety net, but when you look at those regions, you've also got to look around all of China. You've got to look at the infrastructure which they're actually pushing together. And it's that infrastructure which requires this thirst of commodities. When you look at where they were 12 months ago, or even 18 months ago, when they were faced with these primary inputs being so high, a lot of them have dropped 50% in value. So when you plan, and in China when you plan, you don't plan just for next year. You plan for 5, 10, 15 years.
We could bang the Chinese drum all we like, but as with any investment stratery, you've got to hedge, you've got to diversify, as they would say. Now let's move our eggs away from the basket that is China. Let's talk globally, because if you look to the European era, the UK's a basket case. Now, where's the prospect for us making hay in that part of the world if an economy like that's on its knees?
Well, what we do with our models, and you're right, you break it up. Europe, Eurozone has always been relatively slow. It's just been that big mover. It sort of fluctuates up and down. Obviously, we've got a few more concerns in the UK. But when you add that, you see that Europe is slow to react, slow out of the recession, all those sorts of things. Then come and look at America. Third quarter profits are coming through, all very, very positive. And that's a positive picture we're starting to pick out of the number one economy.
But then again, like Baltic Dry coming off a very low base.
Coming off a very low base, which is fine. But you've also got commodities at a very cheap rate as well, when you compare them to 18 months ago. So looking at that, you can start to paint this picture where if we continue to be robust in the economic outlook, Asia, America, and if Europe starts to pick up, then you might get this case where you have more money chasing less product. And as you talked about that inflationary hit just a moment ago, that could start to develop if in fact we don't have supply, if in fact we don't have stockpiles. So those economies which are really moving, or those economies which are showing 9% growth, India 7.8% growth, they've got to look for somewhere for these commodities to keep coming through.
Tell me about this ASEAN so-called move to bring about a bloc similar to the EU. That would kind of suck up Australia and New Zealand as well into that equation. Do you see a tangible benefit, or have we already got the deals in place, the bilateral trade links to warrant the good returns before
I
worrying
think,
about
I
it?
think we've already got a lot of them already in place. I mean, Australia is placed as a super energy power, effectively going forward. You've got so many primary inputs that so many people want. So when you look at it from that perspective, it's only really going to enhance what we can offer to the group. So if anything, I think it's just a seal or a stamp of approval that we're part of a bigger picture and we're part of a big picture that's growing and moving.
Do you think it would be a subtle, though, move to get FIRB maybe to go easy on things if there was to be some sort of a regional understanding on ownership, that could water down any opposition we might be having to date about the long-term Australian-owned nature of our commodities?
I think that's going to be really interesting because we are protective over our primary inputs, what we have in the ground. I actually think they'll probably keep it separately. Okay, I think you want to keep them separate because you don't want to have too much ownership leaving Australia. You want to obviously have the funds that come in to help develop, and you want to have an agreement that works with those companies that want to invest in Australia. But when it comes down to selling off the farm, I think it has to be separate to these other issues.
Okay, moving back, if we can, into the oil price. You're saying 102 US a barrel is not inconceivable, but you are buying, you're taking a long position, but buying on the dips, seeing as an excuse to buy, believing we could see an upward trend. What will power us further?
Look, I think when you look at the oil picture, we've managed to move up, broken through that 74.50 on the back of inventories which are up above 5-year highs. So when you look at that, you've got a glut. So why our price is actually moving. And I think this is the concern which we have because we're trading higher. The US dollar's not going on major lows yet, and it hasn't yet. It's just holding good support. So if that's the case, why are we continuing to edge higher? And that's what we're doing. We're just edging higher sort of each couple of weeks.
So is it based on fundamentals? What is pushing it up?
Yeah, it's purely based on fundamentals in my mind and demand. And when you see that demand and you look at where it's coming from, it is coming from Asia. If you just combine sort of the three GDPs of China, India and say Australia together, it certainly outweighs the US. I think at the moment we are too US-centric in terms of our views, in terms of commodities. And I think we're actually seeing real demand actually coming up and real demand coming out of Asia.